One example of a non-technology growth stock. There are innumerable examples of non-high-tech growth stocks, and depending on your skills, background, and commitment to acquire knowledge, you should be able to find some of them in the future. Recent examples are Walmart, Home Depot, Starbucks, Chipotle, Danaher, and Eaton Vance. However, in this section, we are going to discuss one specific example of a non-technology growth stock. McDonald's. In 1980, McDonald's stock price was about $1 per share, split adjusted, compared with its price of about $45 per share in 2000. On average, the stock price rose by more than 20% per year, or about twice as fast as the overall market. Even if you bought it in 1990 at about $7 per share, you would have enjoyed at least a six-fold increase in the stock price by 2000. The question becomes whether you should have bought McDonald's common stock in 1990 after the company had experienced phenomenal growth. Over the prior 5 years, the earnings per share grew at a steady rate of about 14% per year, from 28 cents in 1985 to 55 cents in 1990. McDonald's was expanding overseas successfully. So, a person with a good knowledge of the fast food industry and McDonald's would have, I believe, surmised that the earnings would continue to grow steadily. The earnings per share grew from 55 cents in 1990 to $1.40 in 1999. When you identify a company such as McDonald's that has grown steadily, you need to follow up by asking whether the current price is reasonable. In my discussion, I am not including IPOs, tiny companies, or other companies that are difficult to value. The PE ratios of stocks like McDonald's are generally high in relation to their historical levels or the market, and they remain high for long periods. You should not immediately conclude that the stock is expensive and that you have missed the boat. It is uncommon for a growth stock to trade at a low PE ratio. The stock is still worth buying as long as the price is not astronomical, say above 25 or 30 times earnings, and you are confident about future growth. Only in rare cases do stocks trading above a PE of 30 generate high returns over a long period. By 2000, McDonald's PE was 32. A PE of 32 was high in contrast to its median PE of about 18 in the prior 10 years, or the long-run S&P 500 PE of about 16. This is when knowledge of the firm becomes important. It was still a good company and was expected to grow, albeit at a slower rate. It was just not a good time to buy. From an investing point of view, one thing you can do is to wait for opportunities in good growth stocks once you identify them. With McDonald's, you would have done well if you had invested in 2003 when the stock hit a low of about $13 per share, primarily because of an outbreak of mad cow disease in the United Kingdom and isolated places elsewhere. The rumors of the demise of McDonald's proved to be wrong. What a bargain growth stock it was! In 2009, its stock price was around $53 per share.